Hello all. Welcome to the latest panel at LA Blockchain Summit, Why Bitcoin Makes a Good Inflation Hedge. My name is Charles Bovaird, and I am Vice President of Content for financial services firm Quantum Economics and a Forbes senior contributor. Joining us for the panel today, we have Matthew Graham, CEO of Sino Capital, Jake Ryan, founder and CIO of Tradecraft Capital, William Herman, founder and managing partner of Wilshire Phoenix, and Octavio Costa, partner and portfolio manager at Crescat Capital. Now, to get some thoughts from our panelists, we would like to ask a few questions. All right, so first of all, the world's central banks have printed trillions of dollars worth of currency this year. The Federal Reserve, for example, had printed roughly $3 trillion in new currency this year, the last time I checked. It is certainly worth emphasizing at this point that Bitcoin's total supply is capped at approximately 21 million units. If central banks continue to print money, how do you expect this to impact inflation? Would anybody like to jump in first?
I would answer thusly. I tend to approach things a little differently from many in the Bitcoin space because I'm really more of a Keynesian than an Austrian economist in terms of economic school philosophy. But I would be greatly concerned, not so much about the short run because of the exceptional situation, but the fact that we now have a 5-year span where M2 growth has exceeded GDP for the first time since the 70s and before that the 40s. And then you couple that with the fact that for decades now we've had disinflationary pressures from globalization, and there's a very strong chance that much of that is going to be unwound. So I think it's not so much about 2020, it's about the longer timeframes and the potential globalization fallout. That's how I would take a look at it.
All right, I'll do my take then. I think there has been a lot of deflationary forces in the technological advancements we've had so far that had an impact on that. I think that in money velocity has been a major reason why we haven't seen inflation as well. But in my view, aside from asset prices that have been rising significantly all over the world, what we have, in my view, is that commodities really haven't moved. We've had a decade in which almost any commodity you look at, from oil to natural gas to iron ore and copper, even silver, went down significantly for the last 10 years. Just recently, some of those started to move up. I think that certainly had an impact on consumer prices in general, and allowed the Federal Reserve to continue to keep cheap money in general. I think cheap money has also, in a way, allowed companies to survive in an environment they wouldn't even probably survive in the 70s or 60s during much higher cost of capital. So I think in the following years, I believe strongly that the amount of leverage we have in the global economic system most likely would lead to some sort of geopolitical issues in which could cause supply disruptions in commodity prices in general. I think at some point investors will start putting money into hard assets. And when we see commodity prices rising significantly from cyclical to defensive commodities, you name it, I think that's when inflation will begin to pick up overall. So far, I think that has been a major reason why we haven't seen inflation is commodity prices, in my view. Not to mention that the debasement of currencies is another issue, but I think it's separate from the actual consumer price inflation that you're referring to, I think, in your question.
My take would be a little bit different. I think the data supports that monetary easing is deflationary. And as we print more money and have lower and lower interest rates, we're seeing that really affects the economy in an adverse way by stunting growth. So I don't think the impact of just the Fed itself is inflationary. What creates the inflation is in addition to easing monetary policy, is we're now getting fiscal policy. We're starting to get more and more spending around the globe. The Treasury, is getting more and more in debt, and we're going out. We're going to be spending. We have a stimulus bill that's already passed here in the U.S. through Congress, and they're looking at a second. And I think it's the combination of monetary and fiscal policy together that could cause inflation in the future. But we've spent more than a decade with just the Fed's printing money and monetary policy, and that has not produced inflation. So I would suspect, and we've seen that for probably 3 decades in Japan. So it's not just the printing of money; it's the fiscal side as well that really is going to create the inflation of the future.
Okay, so if I may clarify, when you basically said that we had a decade where it was all the central banks that were stimulating the economy, right?
Well, the Fed through monetary policy and
Right.
monetary easing,
Right.
was really
Okay.
creating inflation.
Okay, great. Right.
Yeah,
So,
can I just jump in? I think we all know the Fed has been basically controlling, not only interest rates, but therefore risk assets generally, for the last, 12 years. So I think when people say, this time is different and, and what have you, I think that's usually the wrong thing, or typically the wrong thing to say. But I think truly this time is different. We're in truly unprecedented land. I don't know if this, if this is the next crisis happens in 6 months, a year, 5 years, 10 years, but I think this next one will be the big one, and I think it'll probably lead to or to begin with kind of losing faith in or maybe the U.S. dollar kind of losing its reserve status. I think that could probably start it, and I guess it's something that wouldn't be. I look at short term or define intermediate term, but I don't think it's something that I'm looking at in the next 2 years or so, 2 to 5 years, maybe longer.
okay. So does anybody have any final thoughts on that question?
I think the fiscal stimulus point is a valid point. I think, back in after the World War II, certainly that was a huge impact on inflationary forces, and perhaps why it's certainly a more direct way of intervening in the economy overall. What we've seen so far is literally helicopter money. It's money coming into, and for everyone's pockets, and you use that to spend money. So aggregate demand has not been, hasn't increased yet. So the fiscal stimulus so far hasn't really had an impact on aggregate demand. And if that does, I think that would certainly create inflationary forces. Again, there's 2 ways to do that. One of them is going to be through demand, and the other one's going to be through supply. And supply is in my view, through commodities. And in the 70s, it didn't really matter what was happening in the fiscal or the monetary side of things. We've had a oil shock, and that caused the whole inflationary forces to move higher globally. So we haven't had a shock like that in a real long time. And I think if we do, as we've seen in history, amount of leveraging the system tends to cause either war or geopolitical issues. I think there's a pretty high probability that could happen in the next few years.
The amount of leverage in the system too means that if you raise interest rates, that's going to have a much more difficult time tempering inflation. There are a lot of things that quickly add up and create a riskier long-term situation.
Yeah, and again, and apart from that too, is the Fed's, sort of own debt service payments on its own interests when they're raising, it's in potentially a rising rate environment could cause.
They're never going to raise rates, and
even the natural progression of raising rates have been going up, naturally over the last several weeks. So, they can control what they can control, but at the end of the day, it's a market, and I'm not sure how much longer. Like I said, I don't have a crystal ball, but
You're holding out on us here.
Yeah. I mean, yeah, I do. Yeah, I'm just holding out.
It's no longer a market. I mean,
well, I think the most interesting thing actually that you said was about was bringing up the potential implications of USD losing its reserve currency. but you didn't. You mentioned that could be one scenario on the horizon. I'd love to know more about what you think that might look like. I don't know if we have time or not, though.
Yeah, I mean, let me actually. I do have my crystal ball just came out, so it does not look good.
Okay.
It's but I think there's America as a sort of the world superpower or what have you. I think with other countries, sort of. I don't think anybody's exceeded us, but I don't think it's the end of the world if the U.S. dollar uses the reserve status. But it's going to be a really big deal for financial markets and global markets around the world, and it would probably cause a lot of disruption to the system.
I have issues with that view. So who would it lose it to?
I mean, does it really matter?
Yeah, well,
Yeah,
I just don't see any.
It doesn't matter, but I mean, yeah.
I mean, look, the first thing.
I mean, who would you give it to,
ahead,
right? I guess it's the the cleanest dirty dirty shirt, right? So you look at, could be the euro, maybe the Swiss franc, but yeah, I mean, I don't scenarios, right? I think maybe my crystal ball was wrong there, but no, I mean, it's something that certainly you can't take it off the table, Tommy. I mean, you just can't. I mean,
what can I not take off the table?
I'm
not. I'm just asking.
Who do you think is a good candidate?
I don't believe that's my base case scenario. I mean, some people argue that would be China. I would strongly argue that that's probably not going to be the case.
Euro? I think that's highly unlikely to be China, but
you think it's China?
I would be highly unlikely.
Unlikely.
Yeah. So who would you think that would? I think it's a valid. By no means.
It's a fantastic question. That's why I was kind of asking if kind of back at you. Who do you guys think would be?
I personally think the dollar is fundamentally stronger than any other fiat currency in the world today. I can't think of any other currency that would be better than the dollar. I'm not saying that that doesn't create an environment where monetary stimulus begin to just be used to fund fiscal stimulus, and the two mandates that central banks now have is to keep equity markets high valuations afloat at the same time as suppress interest rates. And somebody else made a point about they can't raise rates right now. They can't. You're right, and they have to continue to purchase treasuries and to suppress rates going forward. It's a good question about who possibly could take over the dollar, but I just can't think of one reasonably.
Here's my suggestion. My suggestion is that it's a scenario that can't be ruled out, but if you start to talk about what would a world look like that did not have USD as a reserve currency, my suggestion is the most likely scenario, if we take that as a premise, is that it would be a multi-polar world. I don't think it would be euro comes in and that's the reserve currency, renminbi. That seems to me much less likely than multipolar. Renminbi, of course, is an extremely complicated situation because it's not a free-floating currency, first and foremost. But I do think that in neighboring countries, especially with the promulgation of DCEP, that we could start to see more and more contracts denominated in renminbi, international contracts between major entities. We could see more and more renminbi on the balance sheet in neighboring countries that are geopolitically, economically very much intertwined, if not dependent on the People's Republic of China. That's kind of my sentiment.
Yeah. Look, it's possible. There's $50 trillion of assets in the banking system in China. It's a highly levered economy. I'm not saying other economies aren't, but usually throughout history, what we see is the monetary debasement of those places going forward as a consequence of this debt buildup. But I think we're in the race to the bottom for all fiat currencies. Personally, hard
Okay.
assets look pretty interesting.
Okay, gentlemen, I'd like to move on to the next question. Thank you for all the input on this particular inquiry. So we meant various factors were brought up that could potentially push prices higher in the future. So what I'm wondering is that if, for example, you mentioned helicopter money, but you said that it hasn't boosted aggregate demand yet. No, so for example, if helicopter money boosts aggregate demand and pushes it to the right, and if you take these other factors and they combine to push prices higher, I mean, that could show up in both traditional inflation measures, for example, the consumer price index, but also the price of assets. So guess what I'm saying is that if prices get pushed higher, do you think that it will show up equally between the CPI and asset prices?
Is that a question to me, or sorry?
I think there's a couple of ways that could happen. One, if you think about everybody, we have consumption and production. And if everybody's at home getting stimulus checks, continuing their consumption and keeping that as a status quo, but less and less people are going to work and producing, then we're going to have a lot less stuff and we're going to be competing on that. And the only way that's going to resolve is higher prices. So there's a lot of ways that we can get core inflation or CPI inflation. It may not just be an increase in aggregate demand. There may be changes in production just because of the pandemic. And then I think really if it's just asset price inflation or if it's really Main Street core inflation will largely be determined by how much is this coming from the Treasury and fiscal policy versus how much is coming from the Fed, Treasury and the fiscal policy with Fed and monetary policy. If they're both working in concert, if the Fed becomes less and less independent, more and more meshed with the Treasury, then I think you're going to see, more rules get redefined, more ideas of buying, corporate bonds, buying equities, buying other assets, getting more exotic in our monetary easing policy. And as the Fed and the Treasury become more and more one entity, you're really talking about money printing that banana republics and many other countries that really have seen high inflation will start to see that. So again, it will be what is the mix of monetary and fiscal policy that will really change that, in my opinion.
Okay. Would anybody else like to weigh in?
For me, I think the probability of asset bubbles is considerably larger than the probability of CPI inflation in the short and medium term.
Okay.
I'm much more concerned about the possibility of S&P 500, for example, decoupling from intrinsic value. I think that's something that is much more front and center, short and medium term.
You don't think it?
So S&P decoupling from
What's that?
The S&P decoupling from intrinsic value. What do you?
Intrinsic value? Sure.
No,
So,
I understand. I understand what intrinsic value.
Oh, sorry.
Yeah. I'm just never really heard that. So what do you? I mean, that I think. Are you talking about higher multiples, earnings multiples, or what are you?
Yes.
Okay.
Yes.
Yeah. I mean, how much higher can it really?
Yeah, equity bubble.
We're already unprecedented.
Sure. So I think that's a good point. I would concur that it's a current concern rather than a theoretical concern. I would agree with that.
Yeah.
Yeah. If we have unlimited money chasing limited stuff, then that limited stuff is going to get more and more expensive. So stocks, gold, bring it back to Bitcoin. Anything that is going to be more scarce is going to get more expensive as we get more and more money, more and more, the denominator of that becomes higher and higher and we print more and more money. So yeah, I definitely think we'll see asset price inflation to continue. And I think those more rare, more scarce, more provably scarce assets are going to do much better in an environment like
I'll weigh in a little bit on, well, I do think that that would show up on the CPI, even though, it is largely manipulated index, but it would probably show up in a significant way, perhaps very understated. There is an issue we've seen so far in one part of the market, car prices. We've had, it hasn't been driven by demand. It's not like people are buying cars left and right. The issue with car prices that are all-time highs, it looks like the NASDAQ index, if you look at used car prices today, it's mostly due to a lack of production. A lot of companies, due to the pandemic, have not produced cars as much. So if you're shopping for a car right now, you might have to pay 10 grand more than you used to pay on a car. That's just due to a lack of supply, a disruption there. So that's one thing. I think the question about inflation, which is perhaps a little bit related but different than the debasement, is a very big deal for especially the equity market. At multiples that we are today, pretty much at all-time highs in any fundamental metric you look at, I think it's going to be very difficult to justify those valuations if we have inflation in the horizon. So I think that could certainly change the picture for inflation. As a money manager, I think it's important to search for assets that are cheap relative to the money supply index, for instance. You can find, commodities are a very great example of that. If you look at equity prices today relative to money supply, basically they're all-time highs. They're retesting levels of the tech bubble today. So it's very difficult, but I think that inflation is a very important question for any equity investor today. And it will probably mean lower growth if we do have that happening going forward.
Okay, so you mentioned that it's important to seek out assets that are provably scarce. So what I'd like to get into is if prices continue, if prices push higher, whether it's for the consumer price index and or the price of assets, what do you think that sort of thing, what impact would that have on Bitcoin?
Well, I think it's going to do particularly well in that environment when we have, let's talk about gold and Bitcoin for a little bit. I mean, gold, we have to assay, we have to insure, we have to store. We've seen the greatest scam, I think, in gold, what, a couple $2 billion worth in China of it being tungsten and not real gold. So the idea of provable scarcity is one that is becoming more and more interesting to more and more investors. Bitcoin implementing the first idea of triple entry accounting, the idea of being able to know exactly and prove exactly who owns every piece of partial and Bitcoin. That the whole idea of triple entry accounting and being able to have a cross-boundary system that allows you to look for and ensure ownership is going to be more and more interesting. So I think that coupled with its scarcity and its increasing acceptability in the financial markets and other markets are just going to do very well for Bitcoin medium term and long term.
I'll lean in then. Well, I think that the monetary stimulus and extremes that we've seen so far will probably make investors search for alternatives of the monetary system. Bitcoin certainly fits that category, along with gold and silver, and some others that have fit in the past, copper, for instance, but have a much more cyclical aspect to it. Bitcoin does have too, and certainly a technological advancement aspect to it as well. And perhaps why it moves sometimes very closely with the S&P 500 at some periods of times in terms of correlations, daily, weekly, or monthly, not all the time. So I think it certainly could benefit from this environment. It's what I call the supercharged environment, in which central banks have been expanding their monetary base to suppress interest rates. That is a perfect mix for any asset that serves as an alternative for the monetary system. gold would be it's a bigger market. It's not going to move as much as other assets that perhaps are more asymmetric. Bitcoin, silver are very similar in that way. They have much more room for growth. But I think gold will probably lead the way, not in terms of appreciation of price, just given the credibility and the likelihood of larger pension funds and larger investors to come across the thesis of gold in general versus other assets. But that will certainly benefit Bitcoin and silver and miners and other related assets that are linked to the monetary system.
Yeah, and I think it's to all your guys' point. I think it's just sort of hard, sort of alternative assets generally. Call it hard assets, right? And I sort of include Bitcoin in that bucket, even though it's not something you can hold or touch. But I think it's sort of it fits right in that bucket, and it's going to be interesting to see how it does appear or does perform in an inflationary environment, because obviously Bitcoin has never existed in an inflationary environment. And we can sort of go back and see how gold has performed over time in inflationary periods, and silver and different hard assets. So it'll certainly be interesting to see what actually does happen when it occurs.
Sure. So, yeah, I would phrase it like this. So since its genesis, Bitcoin has mostly been correlated to crypto-related things. But as it continues to mature as an asset class, these discussions about correlation in the S&P 500, things like that, they become much more serious, much more realistic. If you subscribe to Paul Tudor Jones's Great Monetary Inflation Theory, and I would encourage you to read his investor letter from earlier this year, he has a fantastic analysis of Bitcoin relative to other potential ways to play the GMI. And so he talks about how you have different horses and you want to choose the fastest horse. And so some horses might be going long the NASDAQ 100, going long gold, going long Bitcoin, playing treasuries, long the 2, short the 30. And so the interesting thing is that Bitcoin, you could make a strong case that it's now one of the fastest horses. And certainly it's one of the horses that you would want in your stable. And that's something that's very new and very important for people that work in the blockchain sector.
Yeah, I would add on that too. We started with the idea of provable scarcity in this topic. And I think if we look at collectibles like rare cars, rare wine, and how those have done over the last 10 years, you've seen a great outperformance compared to S&P 500. So really collectible art, really collectible wine and cars, because of their provable scarcity, are really outperforming the markets. And I think that we can take that into our crypto thesis and really add why Bitcoin and its provable scarcity will do well in the coming environment.
Good point.
I would caveat that though. I would say in the scenario where wealth inequality continues to increase, or at least doesn't decrease, which I'm not totally convinced we haven't reached a tipping point in that regard.
Yeah, great point. And also the with fine wines, collectibles, and art, I think it's about access too, and I think that kind of goes into the to your point, Matthew, about the sort of inequality type thing, and so on.
Okay, so I'd like to thank every single last one of you for making some excellent points. It's time to wrap this up, and I'd like to thank everybody for joining us.
Thanks so much.
Thank you. It's a pleasure.
Thank you.